joins us now, CFO with Page Industries. Mr. Chandrasekar, good morning. Thank you for joining us. How you been, sir? I haven't spoken to you in a while.
Thank you so much. Nice to see you after some time. Pleasure to meet you today.
Can I say that the worst of the margin pressure which Page Industry faced for the quarter gone by is behind because cotton prices have come down, yarn prices have come down, fabric prices have come down?
We have done pretty well. Q2 has been quite good for us. The growth has been about 16%. But if you look at, we had masks last year, which is like a one-off during the pandemic. So the growth without mask, which is not our core business, is about 20%. And also the volume, though appears flat as reported, it's about 7% without masks. The margins are also down by about a couple of percentage points. But then these are all invested in advertisement, in warehouse capacity building, and in the sales and production manpower. So we're pretty good as we talk, and we are quite satisfied with the results we have for this quarter. And overall, H1, Q1 was the best quarter in history. Q2 now is the best Q2 in history of Page Industries. So we are very upbeat, and that is the reason why we have been investing continuously in technology, people, everything.
Chandrasekhar, it may be disappointing for you that now mask sales are negligible, but trust me, for the world, it's a much happier news. Thank God COVID is behind us.
We are elated. We are disappointed that masks are not there, but that was reality last year.
Business-wise, it's just a data point. But tell me, where is the maximum volume contribution coming in from? Because as I understand, that there has been a little bit of a decline that you've seen in athleisure sales. So when it comes to innerwear and athleisure categories, where is the volume contribution coming in from, and where is it that you see it going forward?
There has been no decline. I mean, people who observe Page for a while now, even during the pandemic years when the lockdown was not there, our best quarters in history have been recorded. I mean, these are way beyond the pre-pandemic levels. And the volume contribution will not come from one category alone. Maybe in one quarter, one of the categories like men's innerwear might grow. But athleisure is here to stay. I mean, the awareness which was created and maybe the spurt which we got during the e-com boom in Q1 of FY20 and again in FY21 and 22 is continuing. All categories are growing, and I think if you had noticed, the retail footprint has almost doubled. We were at the end of maybe before the pandemic, we were about 69,000 in terms of retail presence. Today we are well past lakh and 20,000. So all these new stores have started contributing, and each one has this hunger to grow their own business, right? Even if it's a small hosiery store. Jockey is a brand that pulls customers to the shops, and each one wants to do more and more of the brand.
Right. But what about margins then? Are they expected to be maintained at, say, 20 to 21%? Would that be a fair assumption? And I'm only asking because as of now, as we understand, you're not planning to take any price cuts, even though there has been a fall in the cotton prices.
There will not be any price cut, at least in the near future. And we're also not looking at suddenly increasing the prices. We have done almost a 5%, 13% increase in the last fiscal. This time we have done about 3.6 in Q1. So we are not looking to alter the price. We are quite comfortable with the margins, 19, 20% that we are getting. And I think we should get back about 20% in the quarters to come. As I told you, we have increased the advertising spend this quarter. We don't pull back because it is Q2, because Q1 is the best quarter for Page. Q3 is the festive season. So Q2 sort of gets sandwiched between the two. But the momentum is maintained with our plans for the next 3-5 years in mind. So everything that we do, we are now invested hugely in digital media spends in Q2. And similarly, we are continuing to create capacities. We have outsourced a lot of the warehousing. And then we have now introduced a second partner, an MNC. So we're looking at the future ahead. We're creating capacities in Odisha. So we have complete confidence in the opportunity that is presented before us, and also the scope for growth is immense. I mean, there is no ceiling on the opportunities or our aspirations. So that reflects in our investing to create future capacities in manpower, in warehouse capacity, and advertising and reaching our consumers.
Good morning, Nantar also joining in on the conversation. Page is often called the dividend king stock, right? There's a second interim dividend now of 70 rupees that has been announced. The first one was for 60 rupees. I think what the retail investors and others will want to know, will there be another one? Because you're still trailing the dividends paid out in the last fiscal.
We declare dividend every quarter. We only missed during the pandemic in Q1 last year and the year before that. So the dividend policy is about 50% of the PAT, and which we have exceeded in most of the quarters going back. So there will definitely be a good dividend, in a normal business scenario of growth.
0.75%. You're saying 2% is the policy. So I guess everybody can read between the lines. Last year was 370 rupees for the full fiscal. Now, having said that, you talked about capacity addition and things like that. The turnaround story, has that started to also happen in the smaller towns? There were reports that had come in that there was pressure on the wallet across consumer sectors.
We are though we are a premium apparel brand, we are in a very affordable premium, and we are in a something like an essential space. I mean, people don't cut back on their innerwear and athleisure. These are daily essentials. So, I mean, I wouldn't call it a turnaround, because during the pandemic we grew retail presence we are almost nearly double, and we are continuing to add multi-brand outlets, exclusive brand outlets, large format stores, and all that. So we have been doing good. I mean, in the consumer space, some of the sectors may have faced turnaround and all that, but we have actually gained a huge momentum during the pandemic, and continuing that momentum.
Okay. For the longest time, Page industry, in a sense, has benefited because of this shift from unorganized to organized. Indian buyers moving up the value chain, and that has been the real gold centerpiece of the growth for Page Industries. At what level that migration automatically will start slowing down? Because there would be a point at which it will be difficult for you to gain market share. It would be difficult for you also to maintain those historical growth rate. And if that was not enough, if I can just weave in one more aspect, the Aditya Birla Group is moving into innerwear business. There are a lot of other corporate houses which are chancing their arm in the innerwear business.
I would say, more is merrier, because the appetite for premium apparel in India is very, very less. We don't speak of market share, because this is a hugely underpenetrated market for premium apparel. And the overall penetration of Jockey as a brand is only 12% of the potential market size. So none of the brands, including Jockey, have reached to all those customers consumers are waiting. Why I say this is because when we went into tier 2, tier 3, tier 4 cities, the response has been overwhelming. There are people, distributors waiting. There are MBOs waiting to onboard the Jockey brand, because there is a big crowd puller for any hosiery or any other multi-brand outlet. So the penetration is so low. I mean, even with 25 years presence in India, we are only reached about 1/5 of the geography, because India is so huge and vast, and we are the largest single brand apparel presence in the country, with like 20,000 retail outlets, and also if you look at all the other players put together, we have not maybe Jockey maybe 12%, and when you add up all the others, I don't even come to about 17-18% of the potential market. So simply because the potential market is so huge. We alone cannot create all those markets and the others follow. There will be some place where there will be competition. And it is very important for the brand, for us to stay focused, to learn, as well as understand what the others bring to the table, in terms of product, in terms of branding. So we are extremely comfortable with the way we are now, and also continuously improving. And that is why all this business transformation, business process re-engineering, going into S/4HANA, bringing people on board, talent. We are all about talent and culture. So and on top of the premium product, right?
Just to wrap it up with one final question, what would be that watermark below which you will be tempted to bring prices down? I mean, how much more raw material as percentage of sales has to come down? What I'm trying to understand is companies which are good branded non-India distributed brands, they follow a simple strategy. When the going is tough, take the hit, but when the going is good, maximize it.
If you look at a broad level, the raw material prices are about 50% of revenue. And year on year, the price increases which we do are inflation driven, so as to get that 20-21% EBITDA margin. And but there are other inflationary pressures, not just raw material. You have salary increments, you have OPEX increases, inflation on rent and all that. So typically about 3 to 4% or max 5% would be the inflation year on year. So we will have to increase prices by about at least 4% when everything else, in a stable scenario. So there may be years when raw material may go down, but that will be compensated by the OPEX increases. So what we have to hit is that magical number of 20% EBITDA. So prices going down in a scenario like India, in the space we are operating is something which we haven't seen in the last 2 decades in any industry. Maybe there may be exceptions. Uh, so therefore, there is no need for Jockey as a brand, because we are maybe priced one third of some of the very niche premium global players who are very small in size, and also at the same quality. Jockey delivers the same international quality apparel at an Indian price, and an extremely affordable premium brand play. So to your question, I don't see that prices will, unless the raw material crashes by 20%, 30% and goes back to the levels it was pre-pandemic. We don't. I mean, the experts do not see that happening. There may be a correction in Q3, which is happening to the extent of about 3% of raw materials. So people are not having seen the price. The raw material players would not be giving up the price at which they are sitting, so long as there is a demand.
Mr. Chandrasekar, great to have you on the show today. Thank you so much for taking the time out.
Thank you so much. Have a nice day.
Thank you. Okay, that's the word coming in from the management of Page Industries. Let's just revisit what the market is up to before we move forward and tell you what else is happening.